All right, let's talk about the master budget for a company. And if we look here, this kind of makes sense. What you might think a master budget is probably pretty close to what it actually is. It says it's an integrated set of both operating and financial budgets for a period of time. So that begs the question, then what is an operating and what is a financing budget? We can get a little bit of a clue by looking at what the purpose for operating budgets are. It says operating budgets can be used to prepare a budgeted income statement. So when we talk about operating budgets, what we are talking about are items such as sales and all of our budgeted expense items. If we think about a financial budget, it says this information is used to produce a budgeted balance sheet. Now, this is not the balance sheet, just as this is not the income statement, but financial budgets provide information to compile a budgeted balance sheet. So a financial budget then, the purpose of that is to say, okay, how much do we need to pay off items such as liabilities on the balance sheet? What do we need for the acquisition of new assets, property, plant, and equipment, and so forth? And then finally, your slide says master budget is generally prepared on a yearly basis. So let's take a look at this diagram here. If we look over here at this operating budget, and this is for a manufacturing company, this looks an awful lot, if we really think about it, this looks an awful lot like an income statement. We have our sales right up here at the top. We have our cost of goods sold next. And then we're gonna jump down here and we're gonna have some other ordinary and necessary expenses for that business. We can take all of this data and produce a budgeted income statement. Once we do that, we have an indication of what our cash budget is for capital expenditures and so forth. And again, we're going to find that translated over here into a budgeted balance sheet. So when we talk about budgeted income statements and budgeted balance sheets, it's very, very important that we understand that these are projections, these are estimates of what we think our income statement might look like at the end of the year, and also what our balance sheet might look like at year end. Okay, so when we get into these operating budgets, there's a lot of information on this screen, but I really believe that if you think about this logically, this will all make pretty good sense. So when it comes to operating budgets, we said already that operating budgets help us produce a budgeted income statement. So we're always going to start, just like we do on an income statement, we're always going to prepare our sales budget first. I'll probably say that more than once. Once we have determined what we hope to sell over the course of the year, we can start coming up with our production budget. Once we have our production budget, we can split this off, and we can, depending on what we're making, we can come up with a direct materials purchases budget, a direct labor cost budget, and a factory overhead cost budget. I will say one thing, I probably should have mentioned this. When we talk about a production budget, we're talking about units of production. We're not talking about a dollar figure there. We're talking about units right here. Everywhere else, I believe we're talking about dollars. Okay, so these three items here are going to ultimately compose our cost of goods sold once we've sold the goods, that is. We also have this line here, selling and administrative expenses budget. These are not product costs. These are just costs for the period. We actually call those period costs. And if we take this and we follow it on down, we take our cost of goods sold, our product costs, and our period costs, and hopefully at the end we will have a budgeted income statement that is in the black, showing net income. So I already indicated to you that the sales budget is done first. I think the further we get into this, the more sense that will make. Your slide says that prior year sales are often a starting point, or they are a major component in the sales budget. But we also have to plan for other things as well. So if you are a marketing person, you can probably appreciate this first item here. Planned advertising and promotions. Now, we have to say, okay, are these items going to be more or less than what we did last year? What about our overall pricing of items? Perhaps, and usually, prices do tend to go up, but we may be dealing with a situation where we have items, products that are closer to the end of their product life cycle, and so prices could go down. That's ultimately going to impact the dollar figure for the sales budget, and then obviously changes in the industry, and then also economic condition overall. Okay? So once we have factored in all of these things, we can hopefully budget our sales revenue, and we have a little formula for that right down here at the bottom. So this is a very, very simple formula. It obviously implies some things such as sales mix and so forth, but this is the appropriate basic formula, all right? Here we have an actual sales budget, and we have a company that looks like they have, yes, we have two products. We have wallets and handbags, and then we have an East region and a West region. And so when we're talking about a sales budget, we are definitely talking about dollar figures. So what we have here is we are estimating sales of 287,000 units and 241,000 units for our wallets. Looks like the sales price is the same in both regions, so we merely do some basic multiplication and we come up with a budgeted sales figure of 6.3 million for our wallets. And we're going to do the exact same thing for handbags. Looks like they sell for more money, even though we're not selling quite as many of them. And that's going to add 7 million. And so if all of these things were to occur exactly the way we've got them here, we would have a little bit over $13.3 million in sales budgeted for the year. So I want you to understand this is not what has happened, this is what we are estimating might happen. It's our best guess. So one of the reasons why we have to start with the sales budget and not the production budget is because we base our production on existing beginning inventory that's a part of finished goods, and then also what we want to have for desired inventory. So we can't start off with production and then just multiply that out by the sales price, because that's probably not going to match what we actually want to sell in total units. And we have kind of an example of that right down here with our wallets. Looks like our beginning inventory is estimated to be 88,000, but we're only having a desired inventory of 80,000. With handbags, we're going the other direction. We've got a beginning inventory of 48,000, but we want to build that up. So whatever our sales budget is, we're actually going to have to produce a little bit more whatever we're going to sell plus 12,000. Here, it's whatever we're going to sell minus 8,000, because we want our inventory to decrease slightly. So here is our production budget for the same company. We have our expected units to be sold from both regions: 528,000 wallets, 280,000 handbags. We're going to add to that desired ending inventory. These were the two figures that we had on the previous slide. This is what we want for ending inventory. Our total is 608,000, but that's not what our production is, because we already have some beginning inventory. In the case of wallets, 88,000, handbags, 48,000. So we're going to subtract those items out, and we're going to come up with the total units produced: 520,000 for the wallet and 292,000 for the handbags. All right, let's go ahead and stop this video so it doesn't get too long, and then we'll pick up direct materials next.